Welcome to the series on option trading. A key overriding objective of this series is to bring a retail trader at par with an institutional trader and also to enable a complete non trader to trade like a professional. So, whether you're a young professional, a retiree, a housewife, an existing trader, or a wannabe trader, you can benefit from this. A vast majority of retail traders keep losing money in financial trading regularly, and that generates a perception that trading is risky. But we need to remember that professional traders are becoming richer by the day from the very same financial markets from the same trading. In this plot, the blue line shows the direction where professionals are betting their money on a day by day basis. And the faint red line shows the same for the retail traders. And the green line shows the movement of Nifty. So this is the blue line, which shows the combined position of foreign institutional investors and professional traders. The green line shows the movement of Nifty, and the faint red line shows the market direction bet that retail traders are taking. You will see that retail traders, by and large, seem to be trading completely against the tide of the market. This is because they lack the necessary know how of professional traders who make the same market work for them and keep getting richer. Today, an individual sitting at home can be at parity with an institution, and this is because of a troika of three forces: highly scalable yet cheap computing power, huge amount of free data published by exchanges every day, and the market regulator taking steps to level the playing field even further, and finally, knowledge. One doesn't have to go to a university today to acquire knowledge. In fact, there are better sources like this series which distills the most practical concepts that actually work in real world trading and presents it in a common person language. Most people get nervous whenever there is a market fall. Now, this is because they bet on one side of the market, that is the price going up. A better way to make the market work for you is to align with its prevailing mood and profit in all scenarios. Another game changer is that you can leverage your existing stock portfolio also as your trading capital and earn a regular flow of income even as you wait for longer term capital gains. And this is exactly what all big investors do. All big investors are also shrewd traders. They extensively use options to not only defend the huge stock portfolio but also to gain a regular flow of income from it. And this is exactly how they make their portfolio work in all market conditions. Here is a small section from Berkshire Hathaway's 2017 annual report. Berkshire Hathaway is a holding company of Warren Buffett. If you notice here, Berkshire Hathaway makes hundreds of millions of dollars every year through just derivatives. And these derivatives are largely index put options and stock options, as has been declared explicitly elsewhere in this annual report. So, apart from being a legendary investor, Warren Buffett is also a prolific options trader, which he uses to defend his huge investments in company stocks and also to gain a flow of regular income. And closer home in India, all big investors do the same. Rakesh Jhunjhunwala himself is another prolific option trader. For the same unit risk, and risk for a trade can be measured as probability of loss for that trade, and for a portfolio, it can be measured as fluctuation in the value of the portfolio. So, for the same unit of risk, options by far yield the highest return among all financial instruments. And it is quite normal to achieve 2.5% or more returns per month with options, which any seasoned option trader can tell you. However, what is great about this is that one can achieve this return at a risk exposure significantly lesser than the risk exposure in financial investments that only work if the price goes up, like mutual funds or stock portfolio. And we'll see in the next two videos how this plays out. Now, 2.5% monthly returns compounded month by month adds up to 34.5% annual returns. And there are seasoned traders who can earn much more than this, but we'll stick with 2.5%. Now, let's compare the long term impact of accelerated returns. So, here we took a list of all mutual funds and then filtered down to only those that delivered a compounded annual return greater than 15% since inception. That narrowed the list down to only 20 funds, and out of these 20 funds, these are the average returns by category. So let's take the category with median returns and see its impact on 10 lakhs or 1 million of currency value over the next 10 years. So at a velocity of 19.2% compound annual returns, an amount of 10 lakhs will grow to 56.9 lakhs over the next 10 years. And if the same 10 lakhs were deployed in option trading, it will grow to more than 3 times of this to 193 lakhs. Now, if this 10 lakhs were instead invested in a stock portfolio instead of a mutual fund, we can get dual returns on it. So here we have considered 15.5% coming from stock portfolio appreciation and another 34.5% from option income on the same base capital of 10 lakhs. So at a combined return rate of 50%, 10 lakhs can now grow to a staggering 576 lakhs over the next 10 years. And this is exactly how big players play. And these returns are quite achievable with the requisite know how. It primarily requires approaching the market scientifically using simple financial maths and statistics, and computer science helps us in sweeping through huge financial histories and other market moving information to provide profit signals. There are three key elements of profitable trading: know how, algorithmic sophistication, and the right emotional wiring. Know how here refers to your knowledge of options and being able to scientifically interpret the market moves. Next comes access to a sophisticated software tool that harnesses the advances in computational finance and artificial intelligence to provide a forecast of future, probability of profit of your trades, and rigorously backtested accuracy scores. And finally, you need to have a very disciplined mind and trade on preset mechanical rules. A word about the structure of this video series. It consists of several bite-sized, easy-to-consume modules. There is a special emphasis to keep the language simple for anyone to follow. You need the knowledge that works, not the terminologies. Then there are examples and exercises which help to ground basic concepts which are very important in real-world trading. And along the way, you can post your queries and get them answered. Alright, in the next video, we will confront a common unspoken notion that derivatives are risky and complicated.